Yeah, the main market observations in the last quarter was that it was a challenging quarter. 2023's momentum that began in Q1 and Q2 really halted in Q3, leaving very few places to hide. Market forces that influence the stock prices include higher interest rates. We expect them to be longer here. We've seen elevated inflation across multiple different marketplaces that both consumers and businesses will have to navigate through. The stronger dollar is impacting company balance sheets. Surging energy stocks, not only, not excuse me, surging energy prices did benefit energy stocks, but it also creates increased costs for some of our businesses. The IT spend remains in a bit of a down cycle, with businesses focusing on cost-cutting initiatives rather than growth initiatives. There's general weakness in China, specifically around real estate and the consumer. And then, of course, the war in Ukraine continues to wage on, and the U.S. Keeps kicking the can down the road, putting our own debt ceiling at risk sort of every quarter or so. We hope to have a long-term solution for that in the coming months, but we'll likely be talking about that next quarter. Looking at recent performance, our attribution shows that we had a slightly positive attribution from our allocation. Just the sectors that we end up getting investments in added value, and really stock selection was what drove the negative performance for the quarter. This can happen specifically in short-term time periods, but we typically use that volatility to upgrade the portfolio. The recent challenging period hasn't really brought forward any aha lessons. It's really reconfirmed the way we approach markets. These volatile periods are typically in the short term, and they hurt. But that's where we do our best work. The investments that we make in volatile periods, when stocks go on sale, when there's blood in the water, or when other investors are fleeing the marketplace, we are there having our work done in advance to be able to upgrade our portfolio and really tend to put positions in the portfolio that will drive the forward 5 and 10-year return stream. We always take a patient long-term view, and that's typically validated as we come out of these volatile periods. Periods like the third quarter really support us owning high-quality growth companies with long-term tailwinds that have expanding moats and supportive cultures. Unprofitable companies, or those relying on debt, typically get exposed first, and our philosophy and process of avoiding those businesses will hopefully allow us to protect capital in negative markets and give us dry power to be able to allocate into businesses that come to us in terms of cheaper valuations and buying opportunities. A company that we added in the past quarter is Saab. Anyone who's my age or older might remember this as a car company, but really it's become today to become a pure defense business. They have a strong set of programs within the company. Sweden is likely to be included in NATO. But what we've seen from a cultural perspective, there's been a reorganization to be leaner around manufacturing and a greater alignment with their customers. This is a margin expansion story as the company produces fighter jets, anti-tank missiles, and surveillance systems. The cultural turnaround was really led by their new CEO, who came in around 2019. He turned around operations and really globalized the business. So we're taking a company that in the past had really focused on putting sort of mid to expensive sports cars on the road, and now is playing in the very consistent and growing area of global defense. This business historically grew at 3 to 5% per year, but it's our belief that the leadership within the company and this cultural reorganization could lead to double-digit percentage growth in the coming quarters.